This is the Twin Cities Real Estate Investing Show. Real stories, real success in Twin Cities real estate. Join your hosts, Adam Tafel and Tim Swierczek, as they dive into the world of Twin Cities real estate investing. Together, they share valuable insights and practical tips to help both new and seasoned investors navigate the Minneapolis-St. Paul market. With a focus on relatable stories from real people, this show will empower you with the knowledge and confidence to thrive in your investing journey. Guys, take it from here.
What's up, Tim?
Hey, how you doing, buddy?
We have Andy Shornack today. This is your friend. Why don't tell the folks about him?
Yeah, well, Andy, so here's the thing. I've known of Andy for quite a while, but I've never met him in person prior to that, right? But I know him because he's the president of the bank that I bank with. And so over the years, somehow I started seeing him on social media, Facebook specifically, and he started commenting about our show, the podcast specifically. And so I knew he listened. And I had a couple of Facebook messages back and forth with him over the years because I wanted to meet with him for commercial lending reasons. And so I waited till the podcast kind of got big enough where I thought, okay, we can invite him, like he's heard enough episodes and everything else. And I thought he would have an interesting perspective that I think a lot of investors don't know. There's a type of banking out there that most people are unfamiliar with. Not everyone, but most people are. And I thought it would be a good perspective.
This guy invests in U.S. Postal Service buildings.
Yeah.
So that's how unique this dude is. Okay?
And that needs to be in that needs to be in the thing. It's like how to invest it. No, it's not really how to. We don't talk about that. But it's interesting. His investment is in post offices. And I would guess they're triple net, but spoiler alert, they're not triple net. So listen to the podcast and find more.
Here's Andy. One of the hardest parts of being a real estate investor is finding a decent property manager. Much easier said than done. I worked a 10-unit transaction earlier this year, kind of a complex deal, and John and the team at RPM Viking handled the management for our out-of-state mutual client. And I gotta tell you, these guys are professional, responsive, delivered exactly as promised, which is pretty unique in their industry by my experience. They are now my number one property management referral, and I'm proud to have them sponsoring the show. Thank you to John and the team at RPM Viking. Check them out at rpmviking.com. Investors, if a deal gets messy, call Network Title. They can handle the BRRRR, the 1031, mixed use, commercial, whatever it takes so you can close on time. Mentor of mine, guy who I really respect, Kirk Duckwall, says working with Network Title is kind of like having another personal assistant. That's how on the ball these people are. Network Title, complex deals made simple. Link in the show notes. Welcome to the Twin Cities Real Estate Investing Show, brought to you by Shook. Shook is the all-in-one platform to help you manage your rentals, built for real estate investors just like us. What I personally like about Shook, I am transferring, 11 properties over to Shook right now, and the customer service is unmatched. The owner, Oliver, I can text him, I can email him. I set up my VA and Oliver on an email thread, and they are just figuring it out for me. Show me another property management platform with that kind of customer service. I don't think it exists. So, at just $5 per unit per month, I think it's totally worth checking out shookrentals.com or booking a live demo in the show notes. Now, on to the main episode. Well, what's up, Andy? I don't know anything about you, man. I don't know what you do. I don't know why
I'll
you're
just
here.
say this is my request. I wanted Andy to come on. Number one, I saw him comment, but also I'm a member of his bank, and I believe in the type of banking they do. So I wanted to talk because I think a lot of people don't understand what you guys do and where your benefit lies. Right? Yep. They think big company, lots of branches, lots of ATMs. This is where I got to be, and I disagree with that. So I kind of, in some ways, I'm trying to educate the public on what smaller commercial bank. I'm going to call you a small community commercial bank, right?
The reality is we might be, larger than some of the smallest ones, but in the big scheme of things, we don't even have, 0.5% market share in the state of Minnesota. I mean, when you start looking at the actual dollar amounts, of deposits.
Yeah, but what that means is, shout out to Janet. You can call Janet Durfus whenever you want, and she will answer the phone and help you out, right?
Yeah, exactly.
So I have, my banker's in my phone.
Yeah.
So yeah, I mean, you can get great service, and that's not the only reason to use them, but you can get great service.
Yeah.
So.
Yeah. I mean, I just kind of, before we get started, and kind of give you a background. So I'm president of Security Bank and Trust Company. We have 21 locations in and around the Twin Cities. And we were Flagship Bank Minnesota before we merged the two together. And I was CEO of Flagship Bank and president for a while. So I was running two banks. We merged them in 2024. And, our focus, when you go back to like Flagship or even from the beginning, is we financed a lot of 1 to 4 family investor properties. Is kind of where we got our start, right around the University of Minnesota. And then it kind of expanded as the university became huge multifamilies. Then, though a lot of those investors moved into South Minneapolis or North Minneapolis during the great financial crisis, pushed up. And then, the cash flow guys even went wider, right? So as the market gets strong, but that's kind of was our core base. So that grew significantly right up until the pandemic. And then now it's, there's not nearly as many deals as we're getting done, as much as 5 years ago, right? And so we do a lot of investor, duplex, quads, kind of investing, less now today. We do a lot of like retail, strip center, kind of commercial lending. We do multifamily, but that's still a big portion. And then as you go west, we get into agriculture, and there's probably no real estate guys on listening to your pod, but
very little,
and from that perspective. So our branches basically think of it like an arm reaching into the metro. So Glencoe is, about 40 minutes west on 212, and we have branches all coming in, and then we have Eden Prairie, Wayzata, Minnetonka, and then up into Ramsey, North Oaks, and Isani and Cambridge is kind of the thing. And then I live in Rosemount, which is not near really close. Any of them, which is sad. I haven't been able to get my wife to move. So that's just been where we've lived for the last 20 years. But, from a standpoint of that, kind of gives you an idea of what we are. And we basically, the way I look at it is work with owner operators. It's usually the people that are, owning their business, operating their business. It might be anything from real estate to farm to, manufacturing. That's the personality, because to your point, it's the being able to have that person you can call that's got the certainty, reliability, flexibility. If you got a deal, do I know I can get this financed today? Like if you've done 10 deals with us, when you call your banker up and say, hey, I'm looking at this new property, I want to put an offer in it, I can get my letter, I can get the deal done, and I can move on to the next thing. Especially once you get over the 10. Initially, that's how we grew, was the guys that already were at 10, and all of a sudden they needed more financing. Then they came to us and they started, really piling them on, in that let's say 13 to 2018 timeframe. I mean, there was so many deals being done, that it was every month you were closing stuff. Now it's
breaking new records.
Yeah, exactly. Now you don't see as much at least on the 1 to 4 family stuff.
So Andy, back then, were you like a loan officer on the front lines, or were you already executive level at that point?
I've been executive level the whole time since we bought into Flagship in 2013.
Oh, so were you with security prior to Flagship? Or was it something else?
No, I was at a bank called First Commercial Bank in Bloomington, and then they failed in 2012. And I went on to the bank, Republic Bank and Trust, that bought them, and worked with them for a hot minute for 6 to 8 months, and we made a bunch of money on basically hand peddling real estate that were bad deals from the great financial crisis. Like, you guys know Dan Folds? I mean, he's a St. Paul guy.
Yeah.
And, we call up guys like Dan and be like, okay, Dan, we got a bunch of properties in East St. Paul, and, St. Paul, you guys interested? And they're like, yeah, we'll buy, X, Y, Z. And then you just moved them on, right? And you could do that, when you had good people. And so we did that with a bunch of properties, made them a lot of money. And then, this other opportunity came up and jumped at that. So it's kind of a whole different ball game. So I don't know where you want to go or what you want to do, but I'm happy to talk in terms of, investing ourselves. I think most of our lenders also are investors, in some form or fashion. I'm in the postal service. So I own commercial buildings leased to the postal service, which is probably more of a unique animal, but that's about as the extent that I'm willing.
Triple net government leases are your
highest, that's your risk pretty tolerance? Simple. Well, and we bought condos back in the day and flipped them, that kind of thing. But that market is basically non-existent, right? You can't buy failed condo projects and liquidate them anymore to make money.
Let's talk a little bit about bank appetites, because I think most people don't understand this. They think if I go to a bank and it's profitable, they're going to be making money on me and they want to say yes, but that's not true. Can you talk about like the appetite of the type of deal a bank wants to do? Like, for example, someone could come to you with the most profitable bowling alley ever, and I'm guessing you're going to say no. Is that correct?
Well, depends on where and the business operations.
So your appetite might be also location, right? So let's just talk about some of that kind of stuff, right? Like, what do you look like? What do you look at?
Yeah, I mean, so do you want me to? Is there like any official start, or we're just going to kind of keep going?
We've been recording. Yeah.
Oh, okay. I wasn't sure how you want to do it. Yeah, no. I mean, our appetite really comes down to we're a Minnesota-based institution, right? So we're looking at deals in Minnesota, and we're really kind of focused on the metrics that are within our markets. So we try to stay within the Twin Cities region, and it could be real estate that's supporting a bowling alley. It might be real estate that's supporting a Caribou Coffee anchored strip center, or it might be it's more kind of unique user kind of projects. But our appetite, obviously, when you start to look at like 1 to 4 family or multifamily, those are pretty location dependent and what can the rents and the overall cash flow look like. When you get into more commercial real estate, you're seeing the very similar things, but then it gets more into like leases and some of that component of it, because that's a little bit more sensitive in terms of the replacement. So like if you turn over a rental house, that turnover cost is relatively low compared to if you're turning over a bowling alley, or if you're turning over an office building project, right? Like office is one of the most expensive, areas to turn over a unit. So, kind of looking at those leases compared to the loan and what the real estate is super important.
What makes office most expensive? I don't do anything with office buildings. I never have professionally. I would think that they would be cheaper for whatever reason. I guess
because
just like
you're thinking because they're a box. Is that why?
Well, just from a construction standpoint, it feels simpler than like, multi-bathroom units, or even building out like restaurants, retail. It seems like they would be the simplest.
You'd think so, but it really comes in the tenant improvements, right? So a lot of times you're signing an initial 10-year lease, right? And the user's going to come in and want to have that look and feel that works for them. And so when that happens, it's just a higher cost. Whereas, if you're looking at like a multifamily residential unit, carpet, paint, a lot of times today, I mean, when you're doing those build outs, you're thinking about that, right? Like I'm going to put flooring in that's not going to be super expensive to tear out and replace. So that turnover cost from one tenant to the next is relatively low compared to, I've got a bank user one time, or maybe I have a dentist user coming in, where you got to add plumbing to every little nook and cranny of the facility. So you're going to have super high expenses. Now, some of those are going to be, obviously a dentist is probably going to stay in the same spot for a long time. They picked it because it's a good location, it's great visibility. Same thing with like Caribou, or Starbucks for that matter, or if you're doing like the single or, some of those types of users, you kind of know that they're buying it for that location piece. Some of the other kind of more, when you get into the retail, it's a little bit cheaper in office, but office just tends to be, and then they're more flighty, right? So, if the market changes or they need to expand or they need to go into new space, they might just move into a better facility. And right now, what you're seeing is people upgrading their space because office so much vacancy. Yeah, exactly. And it's like, okay, well, I'm in maybe a lower quality building, and now I can go up into a nicer quality building with more amenities and fill that space. So that the really top tier buildings are doing better than the lower quality buildings, and there's just takes more time to invest in those.
What do you think about the future of that segment in general, office. I mean, people are getting crushed over the past however many years, I guess since COVID. What would you say to an investor who wants to like explore that realm? What sort of things are you projecting? Obviously, you don't have a crystal ball, and what sort of things would you watch out for?
Well, I think the low is probably in, right? I mean, I think we've probably turned the corner on the worst of it because, you're seeing a lot of the large companies start to bring people back to the office. So, you're seeing some absorption, I would say, on that front. I think the big challenge is, where you're sitting for kind of working capital and structure in terms of to be able to bridge the gaps of any of those tenant replacement or what you need for capital improvements to get that property up to a level that will work. If you're, my office, I office in Eden Prairie, if you're looking along the Eden Prairie corridor, I mean, there's some lease, but if you're, trying to find a space to own or a primary space where it's, you can have office and maybe a little bit of retail, there's not a lot available, right? So, if you're in certain submarkets where that location demand is good, there are good opportunities to invest in that type of space. But if you're in downtown St. Paul, downtown Minneapolis, I mean, you have to have a really strong reason and knowledge base based on what you're trying to do to know that you're going to come out on the other side, or just have that working capital and deep pockets to be able to ride out the storm until, it'll come back.
Yeah, you might know this transaction better than I do because I just saw a newspaper article on it. Do you know about the Polad's building they sold a few years back where they lost like 90% of what they paid and they still said yes?
Yeah, there's.
Do you know that one?
There's a number. I don't know exact one you're talking about. I mean, maybe if I buy via the building, but there's a number of buildings that have gone back at significantly lower values, and it's in some of it is, it depends on how you look at it from, was it the lender foreclosing and, how did they structure? You really got to peel the onion back to see.
Know what happened. Okay.
Yeah, exactly. How those deals actually got sold. Because it can get kind of gray.
Yeah. I mean, just because I think about it and I look at a family who has the means to ride out a storm if they have to.
Yep.
It might even be painful a little bit, but they have the ability to, and they decided it was better to lose somewhere in the neighborhood of $100 million than keep the property, right?
Yeah.
And like, I don't remember if it was exactly 100, I believe it was, but like, it was a lot of money. Like like it was FU money just at one building that they lost on. And so I just wonder, like, you have to really think things are going to be bad to give up that kind of money. So that's why I was curious.
Oh yeah, no. And that's the question, is just how long will it really take to fill that vacancy that's already there? And in certain like Minneapolis, St. Paul, central business districts, it's a lot of jobs that need to come back into the office to fill all the space that is vacant, right? So you're talking, and then you take it to the next step. You say, okay, what businesses are growing super fast that are going to need that kind of space in Minnesota right now? And, how are we attracting those types of businesses into the state? That becomes a whole secondary kind of tertiary discussion. And how are we making sure that we're bringing in those types of companies that they're going to take that space and they're going to want to grow here versus, move to a state with a lower tax or, more incentive, or there's other programs that might, take companies that are growing super fast and adding people and saying, we might keep our same space that we have here, but we might add that location in a state that's maybe more tax advantaged, depending on what you're doing and why, right?
Yeah.
And that's kind of always the balance. Once you get to that large of a size of company, you have those options.
And I would assume Minnesota, like, our draw is probably just the education level and so forth, right? Like we have an educated worker base in general, right? And so we draw a lot of med tech and
Yeah, we have a really strong educational base, high participation rate, right? Low unemployment, so from a standpoint, great, when you look at like the overall benefits of living, lifestyle in Minnesota is really good. I mean, you can go anywhere and go hiking, biking, sailing, whatever your fancy is. We have a lot of lifestyle items that are really close and not far away, which really attracts a lot of that business. And when you think about we've got a very diversified group of businesses. So, you got everything from Cargill, which is more agricultural based and driven, to, 3M, to, Medtronic, Boston Scientific's, doing a massive expansion, to retail, Target, and you got healthcare, on the other side with United Health, group that's been growing, significantly over the last decade. So you have some very major companies, and I didn't say Best Buy, but I probably should, right? I mean, when you look at the number of Fortune 500 companies in Minnesota, it's pretty significant.
And when you compare other metro areas with a similar amount or more of Fortune 500 companies, is there a metro with better like housing affordability in the country?
Ooh, that's a good question. I don't know what the stats are on that, but
who would it be? You know what I mean?
I would think Atlanta. I don't know their whole diversity, but Atlanta housing is, I believe, quite a bit cheaper in here. At least I've seen I've seen stuff, right? Like in loan officer groups, like they'll send out so I think that might be one. I just off the cuff, but there's not many.
And the prices in Atlanta have gone significantly higher in the last decade, right? I mean, it's like you could get a really cheap house, 10 years ago compared to what you can get today.
And it has other problems, right? I mean, from what I know very little about Atlanta, but I do know that it has a crazy bad traffic problem, right? Their roads can't keep up with their with their cars, so that would be one real negative.
And if you look at it from an overall perspective, I mean, since the income is relatively higher compared to the homes, I think that drives some of the pricing components in terms of affordability. And so I think from a housing standpoint, we still have pretty affordable. I know it's getting more expensive. What I think the last numbers was like $400,000 for an average home price in our area, and that's getting up there. But if you want to build a new home or from a starter home standpoint, I mean that's more like $500,000-$600,000. Compared to $250,000 to $350,000 just not too long ago. In some like more core suburban, now you have to go a little bit further out. So you're seeing more people drive and pushing out, and I think Carver just announced like a 500 some home single family development that's coming out, and that's just outside of Eden Prairie and Chaska and Chanhassen, on 212, coming in. And those are some really large projects that are starting to come in. And you're seeing some of that type of activity because I'm assuming now, because, we'll see how the average prices come in, but that some of those homes will be a little bit more on the affordable side as you're getting a little bit farther out, obviously to combat the cost of, living in the core metro area.
Yeah, I'm intimately familiar with with a project in Cambridge that's being worked on right now. That's 100 to start, and then phase 2 is 300. So, yeah. Do you work much with with new construction? Is that like something your bank is into, or?
We do some work with like land development and the dirt moving. We haven't done as much on we do new construction, some select builders. Where we help in projects that they're doing. But we don't have like a massive, large concentration in new construction from that front.
Probably good. It's pretty risky, right?
We all live, I shouldn't say we all, but like I lived through the great financial crisis, and boy, I think at one point I owned, but we were foreclosing on like, a third of Prior Lake. I felt like at one time, because there's so much development going down there along 42. And, it was like, okay, well, we're in that deal, we're in this deal, and all these deals that weren't going. So, you learned a lot, right? It's because, at one point, the lot loans were going for like 150, and they're building these nice homes. And then it dropped down at one point. I think they ended up selling like 50 and 60,000 per lot. Now you think about Prior Lake, a lot like this is probably going for significantly more, and those homes are worth, a lot more. And so you kind of live through those battles and those scars. And so it just makes you a little bit more aware of like what looks like a good deal and what doesn't look like a good deal, right? It's about risk management. Our business is risk management. And so, we're just making sure, from a standpoint of, but, usually if you're constructing on the financing of the home, or you're doing consumer new construction financing, we've done a ton around like the lakes and around, where, there's tear downs were really big for a while there. That slowed down a little bit, but, where they come in, buy a home to, scrape the lot, build a newer one. Those are all things that we've done a fair amount of over time. It's just not, I would say, a large concentration in the portfolio.
You mentioned battle scars and learning lessons from going through that financial crisis. anything that affected the way you would personally underwrite a deal as an investor, not like putting on your personal investor glasses rather than bank president?
Yeah, well, I mean, I'm a believer in the whole, I'm a better businessman because I'm an investor, and a better investor because I'm a businessman mentality. And there's a lot of things you learn. The big thing that I always look at, especially if you're newer into real estate investing, is that, it's the projection component, right? Like you look at a deal and you say, okay, this is what the cash flow is going to be when I step into this. And, I'm going to be able to get this rent, and, my maintenance costs are going to be this. And, this is how, my insurance and my property taxes, and then you get into the first year and you're like, oh crap, I wasn't able to get the lease for what I wanted. Oh, and, there's more wrong than I really anticipated. So, it seems to me, at least based on history, is that, that first couple of years are always a little bit harder than what you originally, until you get the home and the rental fine tuned to the level that you want it. And then it seems to stabilize out in terms of cash flow. But, a lot of underwriting, at least that I've seen on the front end, is probably a little skinny on what that actual real net operating income is going to be in that first couple of years than what it turns out to be, at least based on history. And, and then when you went back to the great financial crisis, I mean, all the numbers were thrown out the window, right? I mean, the rental, you could generally keep the rents were relatively, but then you had the loan to values dropped, and then you had, tenancy issues and, or, trying to turn over the units was a challenge. And so when we look nowadays, if you, fast forward it to today, now you usually don't have like an LTV issue, right? Like the properties, for the most part, the appraisals, we're not running to huge, discrepancies in terms of that portion. It comes more into like the cash flow, right? Can you really get the rent that you think you're going to get? Property taxes have, jumped a fair amount. So, if you look at from a property tax standpoint, how much is that eating into your cash flow, and are you projecting, reasonable increases? And insurance is the major one, I would say, over the last, couple of years, where we've seen really significant impacts on cash flows that weren't anticipated, right? If you go back 5 years ago, I mean, the insurance rates that were 5 years ago and compare it to today are night and day.
Yeah. Which, I mean, I think it's fair to say, like, if we underwrote every deal like that happened, we would have done 0 deals, right? So,
Correct.
like, it's a little reasonable to go, especially on the insurance side, to go, well, we saw insurance increases of X% per year, and I'll just say 3. I don't know if that's exactly right, but it was, an increase, but like a consistent, moderate increase. And then all of a sudden it just effing exploded about 48 or 24 months ago, and they doubled. Almost, right?
Oh, yeah.
It was like maybe 40%
and
the first year.
If you could even stay with your carrier, right? I mean, if you own multiple properties, there's a lot of carriers that just said, we're not renewing, right? And you had to go and find new carriers at a much higher cost to be able to move your insurance. And that obviously frustrates a lot of people. And you're not talking about people that were necessarily struggling. They're just canceling multiple property owners, to some extent, which, it wasn't a claims issue. It was just exposure issue from the insurance company. And that's frustrating from a real estate owner to all of a sudden not really have a lot of claims, but all of a sudden you're getting told you're going to get canceled out and you got to go find someone new. And it's probably going to be at double the cost, or, a significant increase from where you're at.
Another frustrating piece is when you think you have a claim because some bad thing happened to your property that's costing you $7,000, $8,000. And your agent says, well, they'll drop you if you call us in. So don't even bother. And then it's like, all right. And what I did is I max deductible across the board. Cause if you're going to coach me to not even use this, then, and I actually end up saving money. So go figure. That
is important, Adam, to mention. Like if you have a way to be able to do it, right? Like if you have the means to pay a max deductible and you cost average it over a long enough period of time, like, you might really regret that in year 2, but in year 12, not only is it paid for itself, but it was a big win, right? So it's really important to not all of a sudden change your deductible strategy just because you have one bad luck, because if a roof, let's say, I don't remember what it is anymore now, but I remember saying like average roof expectancy in terms of claim, not the actual shingles. And you can kind of figure out like, okay, well, if I own this house long enough, I'm going to replace a roof and I'm probably going to claim it on insurance. And I can look at like a $10,000 deductible and start figuring out like what makes sense. So,
Well, and it's like the $1,200 roof deductible doesn't even exist anymore, even if you wanted it to. Like, they have special claims for hail and wind, which didn't exist a couple years ago.
And they won't even insure after a certain amount of years, right? So
I'm dealing with that on a couple properties right now. And just for everyone to know, like, if it's more than 15 years old, you're going to have a problem and pay more insurance. Correct. And if it's about, I would say approximately over 20, you just don't have anything other than super high risk coverage carriers. And they want proof. It's not a verbal. Yeah. They're going to need to either see a permit that was pulled or receipts, one or the other.
They're getting tight.
Yep.
You mentioned at the top of the hour about how you became prominent in the university area doing a lot of those properties, right? University of Minnesota. Where do you see the 4-year college and people moving to college? Is that going to like keep happening for decades and decades? Do you think that's going to shift at some point? I don't even know if any of us are qualified to answer that question, but I think it's an interesting conversation topic because less folks are going to 4-year schools. I think that is for certain.
Yep.
And younger folks, you have kids right now, Tim, maybe you could talk about this, who are making this decision. People are becoming disillusioned with college. I didn't go to college. A lot of people I know who are successful didn't go to college. And then what's going to happen to all that real estate? What do you guys think?
Yeah.
Well, I mean, University of Minnesota's changed a ton over, I went there for undergrad and what it looks like, today versus what it looked like, when I graduated in 2004 is night and day. Right. And so, a lot of those smaller, projects, have changed in terms of the kind of what's been, used and how they're being used now. The demand for college historically is, when you go into a recession, more people go to college, right? Because they want to, re-educate themselves and maybe go into a new career line. So that might actually increase demand from where we are today when things are relatively stable. When you look at like an unemployment base in the state is, below the national average at 3.some%, right? Like you have lots of opportunity. And obviously the trades are in strong demand right now. So that's probably, people that might have gone to the University of Minnesota, let's say, are now going to trade school, and that's, takes maybe some demand away. But from a standpoint of like leasing, I mean, we haven't seen any real, we still have a fair amount of properties financed in and around the University of Minnesota as well as the University of St. Thomas. And we haven't really seen a challenge there overall in terms of the tenants or occupancy issues. So I think they're still able to kind of manage through it. And the density of the location of where they're at, I think that makes a big difference too, right? I mean, these are in the core metro areas. So, I mean, one way or another, something's probably going to go on that dirt.
That's a good point.
So I think that's kind of a defensive. Now, I wish I was that smart when I was going to college, and thought about, some of that stuff. But I mean, that's kind of played out really well for those, investors that have been in that area. And obviously the rent for student housing is a little bit different than what you're seeing for a rent for, somebody that's outside of college as well.
I think if you're an investor looking to get into the university area or even university adjacent, which is what we were, is you really have to understand who you're competing against as a landlord. Okay. So if you're competing against Doran companies, you're in trouble. Right? Because I know that was it Pat Doran? That was his name, right? The owner of Doran Companies did pass away a couple of years ago, right? But he was a billionaire, and his company is very well funded and is going to beat you. So, but even like going in there, like the small guys in a lot of that, in the bigger stuff, are building brand new things, and they're 10 millionaires to 30 millionaires. Right? They're not like they don't just have like a mill, right? So if you're going to compete, you have to understand who you're competing against in that market and what they want. And I think that for most people listening to this, you're going to be buying a duplex or a single family home. Figure out what they have and make sure that you can outrun the bear, right? You don't have to beat Doran, but you do have to beat Tim, right?
Well, and some of it is usually, if you're getting a property that's maybe been underinvested in and you can add a bedroom, right? Or some of those types of repositioning of the existing properties, which played out really well for those that figured that out. For a while there, you might buy an older duplex that maybe had a porch that you could convert into a bedroom. You know, like there's certain things that people have done in terms of hacking those properties to increase the rental rates, you know, over the long period, and that was pretty successful for a number of them. You know, it's just now you're seeing probably more where, you know, like you were saying, some of these more established investors, you know, they already own the property and maybe they're just tearing it down and adding more units and more bedrooms, right? And making it more of a project like that that adds, you know, capacity and rent as well.
Yeah, like an example might be near the football complex. I believe they call it the Bierman Building. Just near that building, off on, I believe it would be 9th Street. It could be 8th, but I'm pretty sure it's 9th. If you go one house off the corner, because that's like that was like an auto repair shop, there is a row of beautiful, like maybe 8 plexes or so, something like that, that are like maroon and gold. Someone built those. It wasn't a Doran, but it was someone amazing that's got a ton of money. And you see developments like that all over. Those are great places. You're not going to be able to beat them on price. You have to beat them on something else, which is probably privacy, actually, right? Yeah. You know, that kind of thing.
Do you have, how prominent are bank robberies in Minnesota?
I don't know. Hopefully not very prominent. I'm hoping I don't have to deal with that one. So
has it never happened to your bank?
Well, I not since I've been involved. I mean, I certainly hope that we don't have to run into that issue.
I've been listening to all this true crime podcast.
Yeah.
And they'll interview some like prominent bank robbers, and it's wild. I don't want to give anyone any tips over the
you should listen to the podcast.
Yeah, I don't want to see that happen anywhere at any of our locations. You know, it's a distracting. I mean, now there's definitely been robberies that do happen, right? I mean, that is something, but we've been fortunate, I guess, so far that we haven't had that issue. Yeah.
Cool.
But yeah, it's a sensitive thing that if you go through that, it's, you know, we've had employees that have gone through it at other banks. And
oh, really?
It is, yeah. It shocks them, right?
Oh, I mean, it's traumatic.
Yeah, it's traumatic.
Okay. Question asked. Check. Let me grab a Gatorade. Do you need anything? You don't have anything to drink. Do you want a drink?
If you got water or something, that'd be great.
Okay?
I'll take something. Yeah.
Can we talk a bit about your progression as an investor yourself? Like, what was the first deal that you bought? How did you analyze it? What drew you to it? A little bit about that.
Oh, I mean, in terms of the postal building, you know, at least.
Yeah.
Yeah, I mean. So, I mean, the first one I bought was in 2009. I mean, that goes way back, and we actually signed the deal papers when my kid was being born, so I wouldn't recommend doing that at the hospital. But when your kid is born early and it's closing day, I mean, I think we've all had those issues, you know, where, you know, you got to get the deal signed. But, you know, we bought in 6 post offices over the years. You know, from a deal standpoint, obviously I'm in the banking business, and, you know, risk management's kind of a component. Obviously, government guaranteed makes it a little bit easier. Cap rates, you know, on postal buildings are still pretty high.
Are they
overall?
Really? I would
have
guessed
when you look at it
opposite.
from. Yeah. Well, you'd think so, but you know, there's always a concern that, you know, the government's going to get out of the mailing business.
Yeah.
And, you know, they haven't made money in how many decades, and, you know, there's always a concern that, you know, Amazon's going to take them out or UPS is going to take them out. And a lot of these are in rural Minnesota in terms of our investment. Now there's a REIT that's out there that's buying a lot of these postal realty. They're publicly traded. And they're pretty aggressive in getting out and buying a lot of these. But it's a pretty simple overall. The leases are all pretty standardized, right? So there's not a lot of negotiation from one lease to the next outside of what the rate is. And if you can get taxes, insurance, you know, other additions, and that some of that's carryover from prior years, and some of that's, at least if it's not in the current lease, it's really hard to get, you know, some of those items.
Can you just explain? I just want to make sure I understand. So they're not necessarily all triple debt. Sometimes
correct.
You're actually responsible for the taxes or the insurance or something
and maintenance,
like that.
And maintenance, depending on the projects. And then some of them are a lot easier, right? Like some of the postage stamp brick buildings, you know, you're not going to see nearly the amount of maintenance that you're going to see if, you know, like we've got one where we got to go out and paint it. And, you know, I drove by it this last month here, and it was pretty it needed the paint, right?
Got
like it really faded this last couple of years, whereas we own a couple of them that are, or well, I guess the rest of them are all pretty much brick. And so you don't really need to do any real maintenance. It's usually roof, it's, sidewalks, making sure the doors are working properly, flooring, asbestos flooring obviously was part of the Postal Service's requirements back in the 70s and 80s. And now obviously it's not anymore. So you got to take those out and replace it. And as part of the lease renewals and things you got to think about on that component. The Postal Service always pays at the end of the month, not the beginning of the month as well. I think it's kind of a unique item because there's not a lot of tenants that pay you after they've used the property for the month.
Sure.
But, I got into it. My parents had been invested in real estate their whole lives. I grew up in northern Minnesota, and they had rental properties in terms of single family rentals and multi-family rentals. And then, they have gotten into some of this postal, business years ago. So, I kind of had a knowledge through that component. And then, there's certain brokers no different than any other kind of real estate that focus on specific types of properties. And, there's even an insurance program that's just for postal lessors.
Buildings?
Yeah, exactly. That, everybody in the country for the most part uses it. And so that makes it a lot simpler. So when, I'm out, running the bank, it's not requiring a ton of additional work to kind of maintain, right? The tenant's relatively set. You can reposition if the Postal Service would move, that is possible.
How often do they move?
Not very often. I mean, how often have you seen the post
Never.
office move in a community? Yeah, it doesn't happen too often. And really what they do is they reduce hours. And they have a rating system internally as well, for the different facilities. And so you'll see like they might have been full-time. Now they're into a part-time where they're only open certain hours of the day, and that allows people to come in and get their mail. But that's more what you're seeing. The heavy cost of the Postal Service isn't actually the real estate as much as it is the staffing of the properties. And so, making sure that they have it. And so they've kind of changed how they manage their team. So they might have just kind of more of a temporary service in some of the facilities, but they still pay the facilities rent, right? They're just not open requirement. Now, if you owned a retail building, let's say in the Twin Cities, and you might have actually in your lease clause that you have to be open, X amount of hours in that space, to be within terms of your lease, because you probably don't want to have somebody paying the rent but having a completely dark space because the other tenants also don't like that. Yeah. And there's other clauses that cross.
Interesting.
Whereas
that makes sense.
In the Postal Service leases, I don't think I haven't looked at it that closely. I don't think there's any like you have to be open. I don't think you could probably put that in there and get it through.
Yeah.
You said, well, how often do state or federal governments actually own the buildings that they operate out of?
They own a lot of buildings, and they own a lot of the postal buildings too.
They do. Okay.
In major cities, it's usually a lot of it happened when they were, in the, I think it was like the 50s, 60s, and 70s, maybe early 80s. They did a lot of, building outside of core metros, and then that's where they were leasing. So a lot of them, like that we acquired, were a lot of times from the original builder, or the family that built it, right? They built it. They had a lease in place. It was a 25-year lease. It was coming up for renewal or, after that initial term. And then that's when they look to sell, or the next generation, that might not want to stay in it.
Interesting.
Yeah, it's a different business model.
Yeah. Is that is that the rest of your investments then? Is it going to be post offices for life?
No. I'm for my investing, I like stock market as well. That's kind of more my thing.
Okay.
So I'm a big investor in the stock market and just kind of monitoring where things are going. And like I said earlier, I feel like because I'm an investor in these different types of projects, it makes me a better businessman, in this case, banker. Mm-hmm. So I'm seeing, and reviewing different deals and in a light that really should help our customers as they're going through their projects. Because I can say, as if I was in your shoes, here's what I'd be looking at. and, here's some things to consider. And if, and I think that provides a little bit more color versus just, just looking at it purely based on a numbers basis. Sometimes, like, from my standpoint, that's probably to one of your questions. I don't think I ever really answered in terms of why do you work with a community bank like ours. I think that's part of the differentiating factors that, we're looking at it from, what is your goal? Why are you purchasing, or what's your plan, and trying to think through kind of that overarching kind of strategy. And then once you build that track record, it makes it a lot easier because you can say, okay, so-and-so, John Doe has bought 10 properties we financed and, has been super successful in doing these, and, or, has rolled out of the 10 single family homes and now it's going into multifamily, which we've seen that transition over time as well, right? You go from having 10 individual doors and you say, okay, well, it'd be a lot easier to have one 10-unit building, so kind of rotating into the next level. When they're doing that and making that transition, you can be like, okay, we've worked with you. We've seen how you underwrite. We've seen how the performance has played out from beginning to end on these deals. And it makes it just that much easier. So you have that kind of that certainty and reliability is how I look at it. In working with a bank like ours on that next deal. So you call up and say, hey, Andy, I'm looking at this project. This is what we're looking at doing. It's very similar to the XYZ project we did in such and such town. This is kind of what we're, the mechanics. Is this something you can get done? And we'd be like, yes, I think you can get it done. We're just going to go through underwriting. And then, you can kind of dual track and run. And that works for real estate as well as it does for small business or any other kind of concept in that regard.
Right. So if you have a multi-time client and they come in a property that's where the numbers don't look good necessarily on the surface, right?
Yep.
But you might trust their projections more, or that they're going to run and operate it as they say, right? And so you'll take that into account and go, well, if Joe Schmo brought this deal to us, we just don't like the deal, but we do like Adam. And so we know that Adam has a track record and he has enough other stuff with us that we know he's on solid financial footing. He doesn't overspend in his personal life. So we know that like he can supplement if he needs to, that kind of thing, right?
Yeah, I mean, and that you see that a lot now, right? Because rental rates have increased a fair amount, and some investors take different approaches, right? Like some people like to push the top end of the market. Look at the rental meter. And let's say some are at the low end and just they don't want turnover, right? Like they're all focused on, I want somebody in there and they stick on it because I want to just make sure that the mailbox money is there, right? And then you have the other side of the coin is, I'm going to push the top end of the market. We got another, customer that he will always be as far on the rental meter into the red as possible, because his whole idea is I own X amount of properties and there will be somebody that'll come and pay the high end of the market because in his case, he's focused on more maintenance free type rental properties and he gets it. And so he might have, a churn or an open unit across the portfolio, but he's always pushing an extra $100 or $200 a month in his units. And, his thing is I'm just pushing the top end and I will always push the top end, and he buys a certain type of home that, he's done X amount of, he's got a very systemized process. But the idea being is that, he's really pushing the top end versus, he's okay having a vacancy. Like that's not a concern to him if he has that 1 month out of 12 where he's got to turn over a unit.
So obviously not looking for his name, but can you tell us like what type of property? Because I mean, this is a Twin City based show, right? Yeah. So like what type of property is he looking for that attracts like a high end tenant?
Well, I just think about like, you can do single family rentals, you can do duplexes, you can get into like townhomes. I mean, condos. I mean, there's a lot of different things that you look at. If you look at like townhomes, for instance, you can set up, XYZ builders in the Twin Cities metros have built thousands and thousands of units. And so you know exactly what that unit's going to look like, how many bedrooms, what the layout's going to be. And you can say, okay, that's the kind of unit I buy and this is what I'm going to do, right? And so, and it's similar on like duplexes. If you get into some of the older neighborhoods, a lot of the duplexes are the very similar layout and construction and format. And if those come to market and that's kind of your niche, you can basically say, okay, this is the type of project that I want, and I can get it, and then I can push the rents to XYZ for that type of unit. And, you know, from a standpoint of kind of planning, once you've done, you know, 10 of these, or if you're in a certain neighborhood, like what we've seen, at least historically, is that a lot of our investors tend to stay to certain, you know, it's very rare do you see somebody who owns one in Stillwater, owns one in Duluth, and owns one in Rosemount and, you know, Cambridge, and, you know, so spread out. It's usually like, no, I'm a St. Paul person. No, I'm in Minneapolis, or maybe Minneapolis, St. Paul, or I'm South Minneapolis or North Minneapolis, or I'm suburban or exurban, you know, like I'm along 212 and I buy older homes, do a refresh, you know, and then release them out. I mean, it always tends to have kind of like a normal theme.
Yeah.
And I think that's kind of the key item is, I think if you have a theme and a process versus bouncing from too many different strategies, you tend to do better on the long run on that.
So as a banker, do you like that and take that into account then, it sounds like?
Well, I think, yeah, I mean, I think that goes back to, you know, the 5 C's of credit, right? And that's
Most
character.
people don't know. Okay, yeah.
Yeah. Well, if you look at like the 5 C's of credit, you got character, capacity. I should know all these off the top of my head. Now all of a sudden I'm on the spot and I'm like, collateral, you know, cash flow. Yeah, now you caught me here, Tim.
Yeah.
You know, well, I should know, but I mean,
criminal record.
Yeah. No, I mean, I look at it as it's really a capacity. You know, can you do what you're saying you're going to do? And obviously, character is a big part of that as well. You know, like you told us that you're working through it.
Sorry.
No, I'm guessing. I should have that. I mean, it seems like a pretty easy thing that for some reason I'm missing.
You look it up. You look it up.
In mortgage, they shortened it to 3. They used to talk about 5 all the time, and they shortened it to 3 recently, or not recently, you know, a while ago. So
I'm that person you described. I push the top of the market, and single family homes in good areas where you actually care about the renovation. It was one example in the Twin Cities where you can push that 75th percentile rentometer meter, and it will work if you do it well. It still has to be within the spectrum. You can't just like make up a number, but if you keep it to Class A and you do the type of renovation that isn't just like cheap whitewashing everything, people will pay it, at least in this market.
No, that's where it is. So, you know, like I said, kind of embarrassing. It wasn't able to get all these off the front, but I mean, you got capacity, capital, character, collateral, and conditions.
Yeah.
So conditions was the one that we were missing there.
Yeah.
Great.
You know, and that's, you know, economic markets. But I mean, the idea being is that, you know, when you're looking at these different projects, there's different items that you would go down and go after. And I think, you know, when you start to work, you know, with more of a community bank, you know, and once you start to have more properties, I think that's when it becomes even more valuable, because then you can look at and start using the equity you have across a portfolio in a much more free-flowing way to allow you capacity to continue to add additional properties without having to take a ton of additional cash and re-inject in, right? So as there's value and equity that's being built, you can leverage that a little bit easier once you work with a community bank like ours. And, you know, there's no lines, there's no big red tape. You know, you've got your banker and your phone in terms of you got your questions, and you can kind of talk through some of those different projects or maybe unique circumstances that might not just be a check the box or go down the line item.
Can we talk a little bit about the underwriting process at a community bank? I know most of them have, you know, some sort of a committee set up, underwriting committee, but occasionally there'll be, you know, at certain levels, like, for example, you probably have an approval level. If it's below, well, I don't know what your approval level is, but if it's like, let's say below 200,000, you can just sign off and you don't need a whole committee, right? Yeah. Most people don't know about this. Can you talk about where that is and a little bit touch on why it is?
Yeah, I mean, it's all about risk management, right? So that's kind of the reason why you have loan approval authorities. And really the underwriting, the way it's set up in most community banks is, you know, the lender's your salesperson, right? Like they're the person that's helping, and they're the relationship banker that's supporting the borrower. And so when you look at it as a real estate investor, you're coming in and you're talking usually to that relationship banker, and you're saying, hey, I've got this project, and they'll take the information in. It's a pretty easy checklist that everybody's seeing, 2 or 3 years tax returns, give me, information, let's say, on the property, and do you have existing leases, or are you going to be turning these over and increasing it? And what would your projections be on that increase? And then we'll do an underwriting, so a credit presentation internally. So we take that financial information and we put it into a format that, is more standardized to make it a little bit easier to go, and approve more deals on a regular basis. And like for our bank, in instances, everybody has an individual approval authority, so they can just approve it themselves. And once it goes above that amount, or, maybe there's a policy exception, right? Like there's something that's a little bit, like it's the debt service coverage, for instance, is below 1.2 times to start with, but you're going to be turning the unit over, right? So then maybe there's an exception. So there's loan committees that meet. So like in our bank, we meet every week, and then we'll review, that credit presentation, that memo on that project, and say, hey, yeah, this looks like a deal, that makes sense, and we see the process. And if it's somebody that we've done a lot of business with before, it's like, it's, somebody that's been proven and we understand, and then it gets approved and you're off to the races. You might have to wait for an appraisal, no different than anything else in that process. But normally you'll get a term sheet, or, when you're going through that process, you'll get a term sheet from the bank saying, subject to approval, here's what you're going to look at. And this is what it's going to be. In our bank, in terms of like the structure, with 1 to 4 family rental properties, we do 20 to 25 year maturities, but usually a 5-year reset reprice tied to the 5-year treasury. So you've got a locked in first 5 years, and then adjustable every year up to the 25 years. Yeah. And so that's kind of what you'd see on a term sheet. And usually you got a prepayment for the first 3 years, and then it's, no prepayment.
Would you guys do a cash out refi on a single family rental property?
Yeah, we do it all the time.
All right, let's run through a scenario, because Tim and I talked about this over the weekend. I've never done a cash out refi before. I've also never used hard money before, but I'm about to do both of those for the first time. So I've got a single family house under contract in Bryn Mawr. I'm renovating it right now, and my plan is probably using hard money, which would be an official loan attached to the property, but maybe using private money, which I could construct as not being official debt tied to the property. Yeah. So coach me right now. I guess I'll be all in on this place, assuming I have holding costs and pay for the hard money. Let's say I'm all in at 240. ARV is conservatively 3.25, but could be 350. And rental value is probably like $2,750 a month. So I've done the rough numbers, and it is a very like break even if I'm trying to borrow at the upper end of the ARV. But coach me, what should I haven't even started renovating yet. I want to use your bank. And actually this would be cool if I do use your bank, because the last guy that sat in that chair last week, I'm using him for the hard money. So we could start a theme here. Everyone who sits here gets my business immediately. What should I do, man?
No, I mean, I look at it like that one's a reposition property, right? So, there's 2 different types of cash out refinances. So, in this specific instance, it's not a stabilized property at that point, right? You're going to be leasing it up. So you're remodeling it for a lease, which is different than, let's say, if it's a cash out refinance and you've been operating the property as is for the last 3 or 5 years, right? And you're just taking equity against the existing cash flow. So those are 2 different models, I would say, in terms of that project. So
real quick, does it make a difference if I rent it out while I still have the hard money and then go to you? Or
yeah, I would say that that's when you'd want to do it when you have a lease in hand. So that's, I guess, that would be
okay.
Because then you've got the rent confirmed on what's going to be the process, and then that's when we start to back into the cash flow. So like in that case, I look at that as more of a reposition property than really a cash out refi, even though it, from a standpoint of, we're looking at it as you just bought the property, you remodeled it, now you've stabilized it with the new tenant, and here's what your cash flow is going to look like going forward. So you take the rent, take a 5% vacancy factor, let's say, and then you get into like the what the property taxes are, what the insurance is, what kind of property management fees are if you're self-managing it, what that might look like. And then, we just go down to Schedule E, so we keep it really simple, particularly with single family rentals, because for the most part, that's what's going to show up on the tax. Yeah, exactly. So then it's really, what's that cash available for debt service or the net operating income? And that has to be over that new cash out debt of 120. That's kind of what we look at. So once you take your rent and you take those expenses, as long as that net operating income covers your debt at 120 for the most part, and the LTV is, let's say, 80 or 75% or less, depending on, I didn't do the math quick on what you were saying there for numbers, that it should be stabilized and able to cash flow at the policy limits.
So let me just make sure I understand that.
Yep.
Loan to value ratio, you're comfortable in the 80 to 75 range.
75, 80, yep.
And you want to see my net income 20% over the debt service. Is that what you mean by one? What do you mean by saying 120?
Well, yeah, because you might have depreciation, you might have some amortization or some expenses that go above the line on your Schedule E that aren't cash expenses. So we would add those back.
Okay. Yeah. So, but Adam, you're right. Just to kind of put it in like numbers for people who are listening, pretend that the mortgage payment was the loan payment, not including taxes or insurance, was $1,000. After you've taken the rent and deducted all the expenses, including the tax and insurance get deducted off, you would need at least $1,200 in excess money after those expenses are taken
per
off
year.
If you had $1,000 payment. So if it's a $3,000 payment, it'd have to be $3,600.
I like to think of things monthly. I hate the yearly talk.
Yeah.
Oh, I just gave you monthly. I'm sorry. I was giving $1,000.
But let's say it's $1,200 over the $1,000. That's 1.2 times coverage, and that's what we really look for. And the biggest thing is, like, if you look at it on a starting out basis, lately that's been very satisfactory. But when taxes and insurance are jumping like they are, what was conforming 2 years ago now is no longer conforming, right? So you're falling below the 120, but that's where the broader relationship and how that you've managed and how the property is looked at over time. It's not like a hard default. It's kind of what you call a soft default in terms of that debt service coverage ratio. But you just really want to look at how can you increase your rents at that point to get back to like a 120 debt service coverage ratio. And
I think what I'm hearing is maybe I go a little bit higher end with the renovation that I was planning on, because for a house like this, it might cost me an extra $5,000 to make it a little bit nicer in certain areas, or maybe extra $5,000 in the kitchen, extra $3,000 in the bathroom to get to that $3,000 a month rent mark. Ultimately, I'd like to get my ducks in a row before I close with the refi. So maybe you connect me with one of your loan officers after this. And, I'm assuming you have someone, or any of our listeners, if they're trying to position themselves for a similar deal, you have somebody who will look at like hypothetical numbers to tee it up for a refi.
Oh yeah, no, that's we always look at and talk to anybody who's interested in looking at financing, right? I mean, that's no different than any other lender. I mean, we're there to support. I mean, we're a service organization. So, our goal is, from a bank standpoint, we don't do well if our customers are doing poorly. It's just not possible. We're a pro-cyclical business. We need our customers to be successful for us to continue to grow and build. And so I personally will never put somebody in a situation where I think they're going to fail. So, we're going to always look at it from guidance standpoint as sharing information in a way that we think will help them succeed and not put in a spot where you're going to be stuck and, be in a cross-eyed spot with the bank, if that makes sense. So if you've got a hypothetical or something, we've got 23 lenders, I think, across our branch network, that can, service and answer calls. And some of them do more, rental property stuff. Some do more ag, some do more commercial real estate. It all depends on that component, but as people contact us, we'll guide them to the people that we feel are best fitted, or they can just reach out and ask. And most of our lenders are in the loan committees and talking about this stuff regularly, right?
Cool. And that it goes a little bit to the mechanics of a commercial bank. There's two little things. Something you said earlier and something you just said now that kind of, I think, are different about your banking system or your type of banking system. And one of those is like, if a loan goes bad, it's not a collector who calls, it's the person who wrote the loan, correct? Typically speaking. Yeah. So they don't want a loan to go bad because it's really painful, right? I mean, if you have a loan go bad, it could take up your week of phone calls and trying to track down the person and get keys to the property if they abandon it, all those kind of things, right?
Yeah, I mean, having lived through collecting in the great financial crisis and, doing a lot of that, I mean, it's a lot of work, right? And then it's not only, trying to, work with the borrower, but maintaining that, the property's in good condition, like you mentioned, as it's being kept in that process. And, and with the way it works, that's pretty standardized legal process in terms of, collection. If it gets to a certain stage, it goes through certain process. And the main thing from our standpoint is it's painful. It takes a lot of time away from doing business with your good customers that you want to spend your time working with. But really, I mean, you don't want to get to that situation. Like, if we know that, and I think that's where like borrower to lender communication, where we have good relationships, not just, customer. There's a difference between a customer and a client, right? In terms of a client, I look at it as you're building those relationships. And when you run into an issue and you have a problem, you can feel comfortable that you can call your banker and say, hey, you know what, I'm really struggling here on this specific project. I've got a couple vacancies I wasn't planning on, or there was a big cost, increase this month. Can we go interest only for a period of time to allow us to reposition? And I think the difference with a bank like ours versus a lot of other banks is you might not have that flexibility. It might be, you figure out your money elsewhere and, you keep making that monthly payment.
Yeah. And real quick to interject, Tim, in the case of the type of loan that you would sell or more of a conventional product, if somebody's in trouble, what sort of leeway is, because there's some leeway.
Yeah, well, if you're talking about true conventional products, especially if they have mortgage insurance on them, the mortgage insurance companies have workout programs. They would all call them something slightly different, but most of them will call it a workout program of some type, and they have something. If it's FHA is amazing, by the way. That's one where they just shine. They have standardized programs, and you could potentially not pay a payment for up to 12 months. You'll pay it on the back end. It's not free. But they have, they call it a partial claim. And so rather than the house going in foreclosure, they will modify your loan temporarily to make it work. So there are some avenues. It actually, the proper way to go on that is you have to call your servicer. But most of the people who answer the phone on servicer, especially for FHA, have no clue those exist. So you probably have to call me first. I'll coach you through it. I'll give you the guidelines, and then you'll have to go ready to fight because it will be a fight. Unfortunately, it's not supposed to be, but it just is because they're only trained on, how to collect money.
And are you burying your credit score while this is happening? Probably.
Honestly, I can't answer that. I don't know how that reports. I'm not sure. There's probably an impact. There's almost got to be.
If it's under your personal name, I mean, it's going to be that. And that's one of the other advantages, right? Like we can lend under LLCs, right? And not have a big issue on that front. But, hopefully, you're not putting your customers in a position where you're going to have those conversations. I mean, we all know that, we're not perfect and nobody is, and maybe there's unforeseen circumstances, but, for the most part, it's been pretty minimal over the last several years, right? I mean, the market's been pretty strong. There's not been that impact. So, it's been nice not to have that many conversations along those lines. But then, it also, you paints a much rosier picture than maybe you might get to. But, with loan to values, increasing in prices, particularly on the smaller rental properties, the single family rentals, the 1 to 4 family kind of property types, there's multiple buyers in that market. You don't only have the owner user that could be potentially buying it, but you have plenty of investors that are also buying it and, that are willing to step in and take different prices. And that takes a lot of risk off from a bank standpoint, because a lot of time the borrower, if they are in a stress spot, maybe they didn't see there's still an exit opportunity. If they're having that conversation, it's maybe we need to, take some time and we're going to market the property and sell it versus have to go through like a full collection process, right? Because it's not it's not somebody's primary residence. It's for the most part an investment.
Yeah, and it could be either or, right? Like you said. So there's another thing that's really unique about the commercial bank or the small community bank lending, or at least that you can feel it more in this, is you're audited every year, right?
Yeah.
And it's a pretty painful process from what I understand. I mean, but that impacts some things too, right? You mentioned a soft default. I don't think most people really understand, but you're writing things that you hope will never fail an audit, right? I mean, when you're doing it, that's actually a concern, correct? So can you kind of talk about how like that impacts things? So someone listening understands like, I'm required. I'm like contractually required to give them my taxes every year. And here's why. Because I don't think people know that, and they don't know the why, right? So could you please explain that?
Yeah, no, that's always a pain point, right? Like, is why do I have to give you my tax return, this year again, and part of it is it goes down to it's part of the documents and part of the underwriting, and and we do go through loan reviews and external audits and making sure that, the capacity to repay is staying there. Part of, the loan structure has that debt service coverage requirement, which I talked about, the 120. So we do test that on an annual basis based on those tax returns information. And that just shows that, that you're operating the property and you're getting the cash flow necessarily to make those payments. And here's the proof through your tax return. And it shows, from a capacity and risk base standpoint, is that the bank's got a portfolio of, loans that is good. I think, from like 1 to 4 family, I think we're at like 400 or 500, loans that are single family rental property type 1 to 4 family. And so, every year we have to go and review all of those to make sure that the cash flow is staying consistent. And so that way, when the examiners, the regulators, the auditors come in, it can show that risk rating, this is a comfortable credit, it's performing, the cash flow is stable, and here's the overall performance is doing well. And so that's why we look for like personal financial statement tax returns on an annual basis, just to support that underwriting that the loans are still performing and doing well.
And you're not trying to be mean. This is a government requirement, basically FDIC type requirement, correct? Or something similar, how they're...
Yeah, it's not like an official requirement. It's a standard practice that almost all community banks do to underwrite their commercial, investor real estate, just showing that the risk is being managed. And so that really we're just verifying that the cash flow maintains, so that there isn't a bunch of surprises where all of a sudden, you haven't been releasing the property and it has been sitting vacant for 5 years and you've been making the payments, but it's been deteriorating, and then you go dark, completely dark, and stop making payments, and the property is falling apart, and it's a major maintenance issue to go and pick up and fix, right? That's the worst case scenario. It comes down to, we just want to make sure we're making the payments are there and things are going well, and it's really checking like you said, to some extent we're checking the box, just making sure everything looks good.
You're not going to boot someone because they had a bad year of repairs and they fell below your 120.
Well, we see it over time, right? Like, so, I've been doing this for 20 years now. And, there's years you'll have a streak of, 4 or 5 years of really good numbers, and then you have a roof repair. Mm-hmm. And you know what? The reality is that you're going to write as much of that through your tax return as you possibly can, and that's just how it works. And so, that's where we, look at and try to say, okay, how much of this is required maintenance, and how are you working through it? And it should over time smooth out, but 1 year shouldn't, it's not going to derail your project. Now, if you have a property that just is never getting above the 120, debt service, and say you're 3 or 4 years in, you'll probably get a call from your lender just asking like, well, what's going on here? Like, are you not in the rental, or, or is it a tenant problem, or, walk us through why this particular property isn't working. You might be augmenting it with an outside income. There's a lot of people that have full-time jobs that are investing in real estate on the side, that they might be supporting it during that transition. The benefit with a lot of it recently is, inflation more than covers the loss of return in terms of real gross dollars. So, it's more of an inflation play at that point, but it's still, from our standpoint, the debt service coverage is one of the components of and it usually is the one covenant within the documentation.
Yeah.
Andy, we really appreciate you being here today, man. Do we have any, I know we're at the top of the hour here. Do you have any last questions for Andy, Tim, or anything you want to leave your potential customers with?
Banking wise, I could
anything.
talk for a long time, but I think this is great. I mean, I'd love to have you back at another future date, but thank you for coming. It was awesome.
I appreciate you guys having me. I mean, I've listened to your podcast, and I like that what you're doing. I think you put some great data out there. I mean, I would say it's just, as you're going through this journey of investing in real estate, is just, it goes back to what I was saying, is find kind of that process or that niche that you really want to get involved in, and then find somebody that's already doing it. One thing that, real estate investors are particularly good about is they might not tell you, here's the greatest deal I'm walking. They'll tell you about their past deals and walk you through what they did and what they didn't. And just having those relationships, I think, helps you speed from start to middle. And then, if somebody's even larger, always looking 5 years in front of you and saying, okay, well, what are they doing, or what did they learn? What are you willing to share? Spend some time doing that, I think, is really beneficial. But, enjoy the journey, and have some fun with it, and, find a good banker, bank with a community bank. I mean, it doesn't have to be my bank. There's a lot of good ones in town. But just go out and talk to people. I think you'll find a lot of value in that.
Awesome. Well, thank you so much for doing this, man. It's great to meet you, and I'll see you for that refi in about a month.
Thanks.
Great episode, Tim.
Hey, how's it going, man?
It's going all right, man. About to head out to see a grandma house in Northeast.
Yeah.
We love our grandma houses.
I haven't told you
we?
this, but I'll tell you there. I want to go actually because I have to go do some.
You want to come with?
Yeah, I want to come with.
All right, sweet. It's perfect. It's just me shooting video. We're going to the 3000 block of Tyler.
Oh, pretty. Yeah.
To see a post-war home in the mid-2s.
Was it okay? Interesting. So I sold a house. You probably don't know this, but as a realtor for like a year and a half, and I sold a house.
Really?
The corner house on 30th and Tyler. I sold in 2006. I think they purchased it. I'm sorry, I was the buyer's agent, but I think they purchased it in 2006.
Nice. Yeah, I'm excited to see this one. I'm hoping that their price is malleable. We'll see what happens.
Yeah.
But
I know the area really well. I like it. It's a cool place. My paper route was 2 blocks from there. My paper route was 32nd to 35th, and I had 4 or 5 streets.
nice.
Yeah.
Well, maybe we'll buy this one together. We've never done anything together, have we?
No.
Okay. We got to do that sometime.
If we do it, we got to make it a big thing with lots of
Lots of reels.
lots of reels and analysis. Yeah.
What I wanted to talk about on the outro today is something that a lot of people struggle with. I talk to folks about this a lot, like repositioning a portfolio, when to sell a home. Now, we've talked about this before, but I want to get your perspective on a cash out refi for a rental of mine.
Okay.
And I want you to put on your lender hat, which is always on. Let's be honest.
It kind of is. Yeah.
It's glued to his head. And you tell me what my options are. I've got this single family home in Summit Hill. Okay. It's rented for $3,000 a month. My payment's creeping up there. Maybe it's like $2,250 now.
Yeah.
Insurance
and taxes are
going up. I mean, we're talking a couple $100, and that's not the reason why I'm thinking about doing something, by the way. But I think it's worth $400 to $430, and my mortgage balance is about $200.
Okay.
Okay.
So
Pulling
you
out a
have
calculator.
50% or 50% equity or more.
50% equity in something. And here's you know what, Tim? If this house is the one, okay, so we've done a meetup there. You were impressed with the renovation on this one. It came out really well. Yes.
Yeah.
This is 1100
Oh, I love the kitchen in that one. And I like the lights you chose, which were actually cheap and on Amazon, right? Like $30 a piece.
So here, yeah.
I used them in a couple properties since then, actually.
So here's my reasoning, Tim.
Okay.
First of all, my return on equity is not very good. Yeah. And I'm not very leveraged anymore at 50%. I could be more leveraged. This could be 2 homes, right?
Absolutely.
Secondly, risk of re-renovation. Okay? This renovation looks freaking awesome right now.
Yeah.
I do not want to sell and have to redo things because they're not cool anymore. And think of, dude, styles change somewhat quickly.
And that one has a style, so I could see that. Although, looking at it, it is a modern take on a classic look, is how I would phrase it. So I don't think it's really going to go out of style, but it technically could.
You know, the basement bathroom has the vertical blue tiles, which are very in right now.
Oh, yeah, I wasn't thinking that. I was really thinking that kitchen, because the rest of it you did really classic too, right? It wasn't,
Yeah. I tried to honor the mid-century thing, open floor plan. I love that house, man. Okay, so that's my reason number 2. So one is I'm under-leveraged. The return on equity isn't great. The risk of re-renovation is there. And then I really think I'm in such a buying opportunity right now, Tim. Like, I'm having more of these grandma houses and distressed homes come to me than ever before. And maybe that's just where I'm at in my personal career, but I think it has something to do with the market being unusually, I mean, we have 2.5 months inventory, when for a lot of my realtor career, we had 1.2.
1.9, yeah, or 1.2, yeah, exactly. Yeah.
So I just think, I just want to scoop up a few more deals. But what do I always talk about? How I regret every single family home that I've ever sold, right, Tim? So now, if I turn right around and buy 2 more, am I going to regret that? Maybe, probably not. Also,
because if one property buys you 2, it's not. I mean, you just traded, right?
Good point. So I think I need to get that bias out of my head, and it'll have to be a 1031, which will be kind of annoying. But what are my cash out refi options? And is this even going to work?
Yeah. So can you tell me how long you've owned the property? Because I don't remember. Because it's important when it's like close to a year, right?
I want to say coming up on 3 years, maybe.
Oh, it's been that long?
Or 2.
Did you remodel it after? Because it seems like that meetup was a year ago.
Yeah, but here's the thing, man. That renovation took forever.
Okay, gotcha. Okay.
I got burned by a couple contractors.
Yeah.
Oh, here's the other piece, Tim. I'm like 50% more efficient now with my renovation skills and connections.
Well, that was your first one, right?
Yeah.
Or first major, anyway.
First gutting of an entire property, yeah.
Okay, so a couple thoughts to consider. Number one, everyone always thinks of Fannie Mae and Freddie Mac. On an investment property, single family, they'll let you cash out to 75, okay? That's the max that you can get from them. The benefit to using them is typically lower cost, in terms of, especially in terms of like interest rate and points. But I would say this, recently I found that we have some alternative lenders who are cheaper. So that might not be true. And you might be able to get up to 80. I'd have to actually research, but I think it's possible to get to 80. I'm talking with low rates. I 100% know rates in the low 7s. I know for a fact that if you're okay with a rate at like 7.6 to 7.7, 100% you can get 80%. I mean, I'm positive. I do it all the time for people. It's just like to get that low rate, to combine that along with an 80%, I'm not sure. And it would not be Fannie Freddie exactly, but it would mirror their loan and it would feel like their loan.
Okay.
So 80.
But let's crunch the numbers, because after I pay my closing costs, I feel like when I crunched the numbers before, after paying the closing costs, I was going to grab like 45,000 out of it. And I'm like, there's no point. Maybe I sell it.
Yeah.
You know?
So, this is an interesting conversation. And I really almost always fall on the side of take more money, because it gets so expensive. Well, we just talked about it on the last outro, how much your hard money costs you. It was 12%, right? If you need money bad, you're going to pay 12%, possibly points, possibly more. This money, even though it might seem expensive because you got to pay a little bit more in closing costs, or your interest rate is like 1/8 more, you get it for almost free, right? Comparatively speaking. But we were like, I really want, we kind of go in and we say, I really want 7.25 instead of 7.5. But that quarter point is not that expensive when you compare it to the alternatives. So I think you take more money, which means 80% if you can get it.
Totally.
But do you want me to start at 80 and we'll see what happens?
I think so little about interest rates. My whole investing career, like, I really couldn't tell you. I know I have a 4.6 on one house because that's a good rate, but
You don't even know the rest of the houses.
I don't know my rates, and I know that they're high on a couple. I mean, yeah, like I said, I was just getting really excited about the 12 that I got. So I don't know, I do talk to people often who are very rate obsessed, and I think it's like a distraction.
It is.
Right?
I think it stops them from making a sound decision often. Yeah. Okay, so 80% of 430. So we're kind of assuming the high side of things here, right? And everything works out is 344,000.
That would be sweet.
How much did you say you owed again?
Let's say 210.
210, and you'll have some closing costs. So I'm even going to say 220 if that's okay with everything. You know what I mean? Like subtracting, and some of those closing costs, by the way, are more like escrow setup. I'm not, I'm adding a little for that.
Sure,
but that means you get 124 out.
That'd be great.
Roughly.
Now I'm probably underwater monthly at this point.
Probably, but you're also going to be buying another property that might not be. So you might be neutral when you consider the whole thing, right? Like I say, like you can think of a transaction in a silo, or I think better to add them together, because this house is really kind of like, it's like a stock split, right? You have one house and you're turning it into two. Mm-hmm. Well, initially that two might not look all that special. But now you have two houses going up in value at the same time and two mortgages going down at the same time. And over 10 years, I guarantee you it makes you more money. Provided that second house isn't a dud with like lots of repairs, right? But
I don't mind the idea of kicking money every month towards a house, because I know that my loan pay down is probably more than my underwater amount. You know what I mean?
Yeah.
My principal pay down. And then, just if I can be more leveraged in a market that I think will continue to go up, that's what I'm all about right now.
So if we take 344,000, which would be the new mortgage, and now you're at,
I'll give you the tax and insurance when you're ready.
Yeah, you know what I'm going to do? Actually,
in fact, in the interest of time, I will calculate.
You can just give me both. Let's see here. So we'll go, I'm going to go 7.5 on the rate. I think you can maybe do better, but I'm just trying to like make sure it looks good that way.
I'm looking at $600 a month for tax and insurance on this one.
Okay. So your payment, not including taxes or insurance on a 30-year, would be $2,405. And I kind of estimated on the high side, so I think it might be less than that.
So this could be a break-even deal where I cash out 120. But I want to do, what if my appraisal only comes in at 4? I'm still grabbing 90. Am I doing that math right? Or it's not exactly?
It's not exactly, because it's a percentage of. So
I got to leave that 20% in. Okay.
Yeah. So it's 400 is the easiest one. And the 400 super easy because 10% is 40. So you take 80 off, right? You're at 320. Yeah. So it only deducts 24,000 off your loan amount. So you'd still have 100. It
kind of seems like a no-brainer to hold on to the house.
Yeah, because what did you say the monthly expenses were outside of the
608?
608. So that would be 3,000 a month.
That's what I get in rent.
And it is possible, when I said 7.5, that I do believe there are situations where you could do better, but at 80%, I'm not sure. So I kind of hugged in the middle. Technically, I know I can do it at 7.7. I don't know if I can do it at 7.5, but I might be able to do it at 7.3. You know what I mean? So or 7.2.
Yeah. And what, from an underwriting perspective, is there anything that I need to be mindful of? Like, they're looking at Adam Tafel's DTI for this?
Yeah. The ones with the cheaper rate, they're looking at Adam Tafel's DTI. And the ones with the higher rate are actually looking at, the cash flow on the property. Mm-hmm. And that's actually one of the downsides to that loan type, is they're very easy to qualify for. But in this scenario, we could be at a point where it's like, okay, well, you have to buy the rate down a little to keep that 3,000 a month equal, the 3,000 rent has to equal the 3,000 payment or be a little higher, right? So there could be a little playing around there, we do, but that can be something as simple as changing up your insurance policy if it's within $10-15 a month. There's ways to tweak that.
Okay, and so then my final question is, if they're looking at my DTI, it's rented. How much of that rent, is it 75% of the rent?
Well,
So I need to come up with $700 in DTI or whatever.
Yes.
Roughly.
Yeah. So if it's a full document deal with the lower rates, they're going to give you 75% of the rent. If it's the other loan type, they actually just give you 100% of the rent. They're just trying to make sure that the rent is equal to or greater than the mortgage payment.
Okay.
I do have one lender that still has very, very good pricing if it's below 1%, but let's just say you'd have to qualify for them, and they're not like overly picky, but anytime someone's like, different than everyone else, they get a little more picky. I don't think you'd have a problem, by the way. That's more for other people. I mean, I think your situation would fly through.
Sure. Okay. Well, cool. I hope that you guys found that interesting to listen to. But I think it is a common refi or sell is a common thing we kick around. And well, thanks to Andy for coming on the show. Thanks again to Shook Rentals for sponsoring the pod. Remember, we do have a discount code, TCREI 20. Have Oliver and the gang over there set you up with Shook and Network Title. You're doing a bunch of deals with them right now. I closed a deal with them last week. April Bryan is fantastic to work with, and we really like them too. So follow, share. I don't know when this episode's coming out, but we have a meetup. Go to meetup.com and search for Twin Cities Real Estate Investing. We have a Facebook group where people post deals all the time. We got a good thing going here, folks. So thanks for being a part of it.
Thank you.
That's it for today's show. You can visit the Twin Cities Real Estate Investing.com website for show notes, tips, tricks, and other local real estate investing information. Adam and Tim would like to meet with you. To schedule a one-on-one meeting with either Adam or Tim, go to TwinCitiesRealEstateInvesting.com/schedule.